Good evening and welcome to the Money Show, your trusted destination for investor education, financial awareness and smarter money decisions. And in today's fast-changing world, managing money is no longer optional. It is essential. From rising expenses and changing lifestyle to market volatility and digital investing. Every individual today faces one important question: how do I make my money work smarter for my future? And that is exactly what this show is here to help you understand. And this is the show where today we'll be focusing on senior citizen and we'll be answering their investment portfolio related queries. So just in case you haven't yet sent across your questions, what you have to do is just send across the question on our WhatsApp number, which is 865-797-4571, and the email ID is themoneyshow@etnow.tv. We will connect with you live over a phone call and will help you talk to our expert live and get all investment related queries answered. Okay, so let's begin. And today on the show, we have Aditya Shah, founder of Hercules Advisors, to answer all of your queries. Aditya, hi. Good evening and welcome to the show. We'll start with our viewer questions, and let's just take Mr. Arthur's question. This is a question via email. And so he says that he wants a suggestion on his daughter's portfolio. Daughter is 31 years old and she has Bandhan small cap 5,000 per month, Motilal Oswal mid cap 5,000, Nippon India large cap 5,000. She has invested some amount till now, and the daughter is not happy with the performance of small cap, which is Bandhan small cap and MOSL mid cap. And wishes to discontinue these funds. What should be added to get a corpus of almost 50 lakhs within next 5 years? That's the question coming in from Arthur. Okay, it's a question via email, so we do not have him over the phone line. Otherwise, we could have asked more questions. But having said that, thank you so much for sending us your question. And yes, Aditya, looking at the performance of these categories, small cap and mid cap, it's expected that the funds won't be performing. Otherwise, both these funds, mid cap, MOSL and Bandhan small cap, have been best performers when the market caps were doing good, when the sectors were doing good. But having said that, exiting will definitely not be the right strategy, Aditya. What would you recommend?
So from my perspective, the investor started off the investment in 2024, and in 2024, from 2024 right up till now, small caps have not yielded any returns. So patience is the key aspect when you invest in a small cap fund. First of all, let's decipher what kind of an SIP that the customer is doing. If they do a 15,000 rupee SIP over the next 5 years, and let's assume a 10 to 12% return, this only yield about 12.16 lakh of money, which is way short of what 50 lakh he wants. In order to get 50 lakhs in 5 years, he must do about 55 to 60,000 rupee SIP at the rate of 10 to 12% return. He will reach there. So from my perspective, he needs to increase his SIP if he wants to achieve the goal. Now coming down to the fact that small cap funds have not performed, you must invest in a small cap fund only if you have a 10-year time horizon. Small cap funds are extremely volatile and go through periods of no return and go through a period of very high return. So from my perspective, the investor came into the fund when the fund was not performing well. Bandhan small cap fund is a really very good fund. If you look at the Sharpe ratio, which is the risk adjusted return, that is nearly about 1.01 or 1.2%. So from my perspective, it's a good fund. However, I don't recommend a small cap fund investment with a time horizon of 5 years. If you have a time horizon of 5 years, you should be ideally in a flexi cap fund or a mid cap fund. So from my perspective, a PPFS flexi cap fund would be 10,000. Motilal mid cap fund, they can continue that 5,000 SIP if you have a 5-year time horizon. If you don't have a 5-year time horizon and you can extend it to 10 years, then I will recommend you to continue with both of your funds, which is Bandhan small cap fund and Motilal mid cap fund. There's no need of a large cap fund. Longer the time horizon, more the risk that you can take in the market.
All right, Aditya, now one question I want to ask you. You recommended Parag Parikh Flexi Cap. Now in the Flexi Cap category, this is the fund that's really underperforming. And yes, we all know it's been a hit performer as well now. But despite the performance, you're recommending Parag Parikh Flexi Cap. Any specific reason? We are looking at other Flexi Cap funds which are beating the benchmark.
So, outperformance and underperformance is a cycle. No fund will outperform over a period of time, uh, every year over a period of time. If you look at the risk-adjusted return, you will find that Parag Parek is in the top two or top three, and that is what I am really looking at. Over a period of 5 to 10 years, Parag Parek will be in the top five quartile, and that is all that an investor really needs. Every year, you cannot get a fund which is outperforming. You will go through phases of outperformance and underperformance. I have put in Parag Parek Flexi Cap Fund because it has got a large capish bias. Over a period of 5 years, you cannot go into the market, into the small cap side of the market. You have to assume an orientation of a large cap and a mid cap side of the market because a small cap fund will have a higher risk. You need to control risk if your time horizon is as short as 5 years. Look, in the last 5 years, small caps have not generated any returns now, as last 3 years have been negative. So from that perspective, controlling risk over a shorter period of time will take precedence.
Also recommending an exit from Nippon India Large Cap Fund?
Yes, obviously. Parag Parek Flexi Cap Fund will have a large capish bias together with some bit of a mid cap bias. So there's no need of continuing with two funds which are doing the exactly same thing. So I will recommend not to have that fund and to have a flexi cap fund, which if the small caps present an opportunity or a mid cap presents
Some technical glitch over here, but then let's just recap the advice that Aditya is giving to Arthur and his daughter. So the corpus will be almost 12 lakh in 5 years at 12% CAGR, and in order to reach 50 lakhs in 5 years, she needs to do almost 55 to 60,000 SIP. And definitely investing in a small cap category for the time frame of 5 years can be very risky. You really need to increase your time frame, and it's not only for mid cap and small cap, even for equity. If you're doing via mutual funds, better to have a 5+ years time frame so that the market volatility also factors in and you get a good benefit out of doing your SIP every month. It averages out better. Suggested funds are Motilal Mid Cap Fund, 5,000 and 10,000 can go into a flexi cap, where Parag Parikh flexi cap is largely a large cap flexi cap, but it also has an exposure towards mid cap and small cap. So as far as your exposure in these two broader markets are concerned, you still have it through a flexi cap fund, which is the Parag Parikh flexi cap fund. So that's the recommendation, Arthur, for your daughter. But keep sending us your question. And with that, it's time for a short break. Aditya Shah is connected with us, but then we'll take a break, and after that, we'll get connected with our viewers over the phone call. So stay tuned. Welcome back. You're watching The Money Show, and it's our Senior Citizen Special. Aditya Shah, our guest live on the show, is answering all the portfolio-related queries. Aditya, let's move on. Let's take Mr. Ramesh's question. He's a senior citizen and a long-term investor. Okay, I think he watches you a lot because he's asked you a question on mutual funds as well as direct stocks. So you might not be able to comment on the stock-specific trajectory, but yes, we can discuss about the sectors and maybe the kind of market cap the company has. So he's got investments in ITC Hotels, Kims and BEL. He wants to know the future prospect of these companies, and also he wants to understand if he can continue his SIPs in these shares, and maybe anything else you might want to recommend for investment purpose. So Mr. Ramesh, thank you so much for sending us your question. It is a stock-specific question, and we do have a very stock-specific show called Buy Now, Sell Now at 11 a.m. every day on ET Now. You can send across your stock-specific queries there. But since we have Aditya, and Aditya is an equity expert, whether shares or mutual funds, so Aditya, you're going to help us out. What would you recommend? I mean, we will talk about doing an SIP in shares later, but before that, his picks, because he's a senior citizen and he's talking about direct equity, let's just analyze the risk. The risk parameters. We do not know his risk profile as yet, but still, if he's directed his money in direct stocks, what would you recommend in terms of taking care of your risk?
First of all, if you have invested in direct stock and you are asking someone else for stock advice, it is not the correct way to invest per se. You have to monitor your stocks day in and day out. Quarterly results come in, you have to monitor them. And given the three stocks that you have just told me, it's a very extremely concentrated portfolio and a highly risky portfolio. From my perspective, although these companies are really very good, be it ITC hotels or be it the other two companies, they're extremely really very good. BEL has done extremely well over the period of last 2 to 3 years. However, these companies require constant monitoring. Given your senior citizen profile and given the fact that if you are not able to understand whether you should continue your SIP or not, I would recommend moving away out of stocks and moving into a mutual fund. A mutual fund would take care of all of these problems that you have got, and a fund manager will continue to monitor the investments that you have got. Having said that, those investments are really very good. I don't know your entry point, so I will not be able to comment. But stocks are good per se. You should consult an investment advisor before you invest in any of these stocks. Uh, Specifically on this show, given the nature of this show, I would like to say that senior citizens, if they want to invest in equities, first of all, their investment in equity should be really very limited part of their portfolio, about 10 to 20%, depending on their risk profile. And within the equity portfolio as well, they should stick to large cap or a flexi cap fund, which does have a large cap bias per se. Senior citizens cannot take too much risk in the market, and that is why they should not be going very aggressive into the portfolio. You can either choose a Parakparak flexi cap fund, you can either choose a HDFC flexi cap fund, or some new flexi cap funds are also coming up, such as an Abacus or an Helios flexi cap fund. Any of those flexi cap funds would really do. But from my perspective, shares are good, but will request you to move out of direct equity.
When it comes to mutual fund, do you think that is a better strategy for him? And I can also see you recommending Parag Parikh Flexi Cap and HDFC Flexi Cap. Can we also discuss about the fund portfolio of these two funds and how different or similar it is?
So, from my perspective, as I said, senior citizen with no ability to monitor the stocks, of course, an active and a passive mutual fund is the best strategy to move forward. As I said, a senior citizen will need to stick to the large cap side of the market, not even the mid cap side of the market. Both Parag Parikh Flexi Cap Fund and HDFC Flexi Cap Fund do have a large cap bias in the market. I don't know what is the quantum of investment that he wants to really do. So a mixture of HDFC cap, a flexi cap fund, and a Parag Parikh flexi cap fund, together with a new fund which has the ability, due to the small AUM, which has the ability to generate little bit of higher return. That would be a Helios or a Abacus flexi cap fund. But for a proper advice, we need to understand how much amount you need to invest. But first of all, you need to do an asset allocation and decide if you do need to invest in the equity markets or not.
Aditya, one short comparison. I do not have the graphics to flash on the screen, but I'm still tempted to ask this question to you. SIP in a stock, SIP in a mutual fund. Where can we earn more?
Not about earning more. Stocks can be way more beneficial. However, you can end up losing a lot of money in a wrong stock as well. In a mutual fund, you can get about 10 to 12% return. Base case, you can get about 10 to 12% return, and a fund manager is constantly watching you. So there is no comparison as such.
Okay.
A senior citizen who does not have the ability to monitor those stocks compulsorily needs to go to a mutual fund. It is like taking the medicine on your own or going to a doctor and taking a medicine. Always prefer taking going to the doctor and taking a medicine, because if you take a wrong medicine, your financial health can tremendously get hit and you can end up losing a lot of money. In the equity market, it's all about not losing money.
Absolutely, yeah. Or else what you can do is just contact the Money Show, and we are here to help you with our experts. Aditya, let's move Let's take Sunil's question, and he wants your view on Trust Small Cap, Helios Flexi Cap, and White Oak Mid Cap. Are these funds suitable for long-term investments, and could these stocks also need help to build 7 crore rupees in next 10 years? We do not have the amount that he's willing to invest, and I do not even know the specific reason why he's considering these two AMCs, which are comparatively new, and there are AMCs with funds that have a good history and trajectory to prove, to show the data. What would you recommend?
So he's not given me his SIP amount, but
Yeah.
given the amount and considering a basic return of 10 to 12%, uh, investors should understand I am taking a basic return of 10 to 12% because that is the base case scenario. Depending on your allocation, your return may be higher or lower. So from my perspective, given a 10 to 12% return and his time horizon of 10 years, I see his SIP should be somewhere close to 3 lakh rupees a month, which is a huge amount of SIP that he needs to really do. Now, so within the mutual fund industry, there is a phenomenon that is coming up. The mutual fund industry is opening up to a lot more fund managers, to a lot new mutual fund companies, and they are coming up and grabbing attention of the market by delivering outperformance over a period of 1 or 2 years. However, strategies employed need to be checked. Sharp ratio, which is a risk adjusted return, is a very important metric for per unit of risk that the AMC is taking. You need to see what is the amount of return that it is generating. My suggestion to investors would be create a mixture of AMCs which have a stable portfolio and a long track record with a good fund manager. Together with that, you can add newer AMCs like an Helios AMC or a Trust AMC or a Abacus AMC or a Capital AMC. So what you do is 50 to 60% of the portfolio must be aligned towards the traditional AMCs like the HDFC, the ICICI, Kotak or a Parag Parikh, and 40% of the AMC should be aligned towards the newer AMCs. As time goes on, give them about 1, 2, 3 years. As time goes on, don't compare their returns, compare their risk adjusted returns, which is the Sharpe ratio. If a mutual fund is giving a Sharpe ratio of higher than one, those mutual funds are really very good. Mind you, there will be periods of outperformance and underperformance in any fund. But if you go into a mid cap and a small cap fund, the risks are really very high. And you need to give these fund managers at least about 5 to 7 years minimum. 10 years, if you give, it is better.
So that's the take coming in for Mr. Sunil. But let's move on and okay, let's take this question of Mr. Rajesh Kumar from Uttarakhand, and retired professional with a mutual fund corpus. He's concerned about recent market volatility. He's unsure whether to shift money to fixed deposits or continue with SWP. Also, he needs liquidity for his son's marriage. So he wants you to help him with a safer retirement income strategy. Very interesting question. And all right, so I will let you just explain him in detail what should be done, because a very crucial stage of your life and the corpus and the market volatility.
Generally, 5 years as a thumb rule, what we do is 5 years before retirement, we try to cut down on 80 to 90% of equity exposures. You cannot have equity exposure when your retirement corpus is going to finance your retirement. You have to do a systematic withdrawal plan. So my recommendation would be under your tax implications, you need to check what the tax implications are. You need to shift this money debt products. Nearly about if 5 to 10% of your corpus is allowed, then you can move into a large cap type of an equity product. But most of your money should be into either debt products or fixed deposit. What kind of a debt product? A short-term debt product, given the interest rates have bottomed out. A short-term debt product like an HDFC short-term fund or an ICICI short-term fund is where you should park your money. Fixed deposits are also fine. You could do a systematic withdrawal plan from any of these funds so that you can get the monthly expenses that you have. But as a thumb rule, do not invest large amounts of money in equities if you are into your retirement. You have to use a mixture of debt products, some bit of money can go into a hybrid product where a lot of it is into debt and 25 up to 25% is into equity. And finally, 5 to 10% of it can go into a equity product. However, this will depend from person to person. Their risk profile will need to be monitored. Their expenses will need to be monitored. And from there on, you need to take a call. But cutting down on equity exposure is the right thing because volatility in the market can hit you in the shorter term.
All right, so that's a strategy laid out for you, Mr. Rajesh. And if at all you want to ask something more, you can send across your question. One little thing on his behalf, I want to ask you. He said, continue with SWP. So we do not have the entire SWP strategy that he has laid out for himself. What would you recommend? Because along with SWP, I mean, you need the money for your consumption, but there has to be a share of money that you have to help grow, okay? And looking at the market volatility, we don't know how's the allocation in that area of his portfolio. Any quick tips for that?
So generally, what I do is if you have 100 rupees, so 40 to 50 rupees, I will always save in a debt product. Then what I will do is I will create a bucket of going into a hybrid product where hybrid product due to its equity exposure 20 to 25 rupees will give some bit of higher returns. And then finally, I will create another product, another bucket which has an equity exposure to the
Okay.
large cap side of the market, which will give you
Right.
give you higher.
All right, so Mr. Rajesh, if you have heard this, if you're clear, good. If not, send across the question again. But with that, it's a wrap on the show. Thank you so much, Aditya, for being on the show for our viewers today. And for our viewers, we'll flash the WhatsApp number and email ID. Keep sending us your question. Thank you so much for watching. Goodbye.